How's it going, everyone? My name is Amos, and it's time for another portfolio roast session. This time, it's retirement edition, and it's episode 5 in the series. And by the way, if you can't tell by my voice, I feel so much worse today than I did yesterday. I'm pretty sure I have the flu. I have a fever, a headache. My body is aching all over. I'm congested. I'm sneezing. I'm coughing. Dude, I'm feeling it. It's rough for me. So right now I have Sudafed in my body, Tylenol, and I even did a decongestant nasal spray prior to filming. So hopefully I can make it through without taking too many breaks. But anyways, in today's Roast My Portfolio session, I'm going to be role-playing. And today, I identify as Miguel. What you see on your screen right now, that's me. I'm 63 years old, and I've been working in management consulting for the past 39 years. And as of right now, I'm eyeballing retirement in the next year or so, depending on the portfolio. And some factors to take into consideration: I live in New York, and I'm going to retire in New York because that's where my family is. I'm a big family guy. And because I live in New York, something to keep in mind is that the tax situation is absolutely wild. You see on your screen right now are all the states in the US ranked by their tax burden. And believe it or not, New York State is number 50 out of 50. That's pretty crazy. Almost as bad as them is New Jersey, Washington, D.C., California. The tax man just hits you from every corner. There's income tax, sales tax, property tax. It's rough out here. And before I go ahead and reveal my portfolio, this is really important, so please pay attention. The reason why most of you are going to gasp when you take a look at my portfolio, why it's so risky, well, when I do decide to tap out and call it quits, I have a $500,000 lump sum for my pension. That's $500,000 in cash. That's why I feel like I can mess around a little bit to see what works and what doesn't. However, maybe analyzing my own portfolio will make me reconsider some factors. So my portfolio's strategy is to accumulate income ETFs in retirement to replace my active income. And the portfolio's goal is to try and find the most stable, least amount of NAV erosion income ETFs. Whatever combination that will be. I don't care. Whatever works, works. And I want the highest payout possible because I plan on adjusting my lifestyle according to the payout. So if the dividend income is going to be $30,000, I'll live accordingly. If it's $500,000, you better watch your tone when you talk to me at work, because I'll quit at any second. And on a side note, I think that's absolutely hilarious. There's some of us clocking into work right now where you generate $200,000, $300,000, or even like $800,000 a year in dividends, and nobody knows. And that's why you just don't care. While everyone else is stressing about the end of the year bonus, promotions, you don't care because you have such a huge portfolio. And I think that's pretty funny and admirable. And before I scroll down and show you my holdings, you have to understand my current situation. So when I first started investing into dividend stocks, not too long ago, I started out with the tried and true, the battle-tested, the popular dividend ETF known as SCHD. However, for the better part of this year, as I jumped into the market, I noticed that it was trading flat. And I felt kind of impatient because there were other income ETFs that were generating yields of like 20, 30, or even like 100%. So I jumped ship and I went into the deep pool. And now I'm invested into quote-unquote dangerous ETFs because I'm chasing the yield. As of right now, my portfolio is $2.1 million. And as I scroll down, and I'll show you my 7 holdings. We have the NASDAQ 100 QQQI. I have $800,000 invested into that. I have YieldMax's Alti, about $500,000 invested into that. I'm also invested into the YieldMax AMD Income ETF, Maggie, and Robinhood, but also NVIDIA. And to round it out, I'm also invested into the Round Hill Magnificent 7 income ETF. And as a congregate, the dividend payout, as it stands right now, I make about $965,000 a year in dividends according to the trailing 12 months. And if you take a look at it monthly, that's $80,000 in dividends. Now, if this video was just about Alti, the dividend yield would be higher, but I do have some of the smaller income ETFs like QQQI. So the overall portfolio dividend yield is 44%. And to remind you once again, the portfolio's valuation is $2.1 million. I'm Miguel, I'm 63. And if you want a closer look at the breakdown of the portfolio and the holdings, well, there you go on your screen right there. And to be quite frank with you, just taking a look at my portfolio like that, it just reminds me how crazy my situation is, how blessed I am to have so much dividends pouring in every single week, every single month. However, now let's go ahead and talk about my high-level thoughts and opinions on the portfolio. I'm going to go out on a limb and say that my risk tolerance is pretty darn aggressive because I think it takes pretty big balls to invest $500,000 into Alti, let alone putting $236,000 into AMD, the income ETF. So the payouts do well if AMD's share price does well, as a general rule of nipple. So if AMD stock price is volatile or it declines, then the payouts won't be as good. Plus the share price of $7.37, it will erode and go lower and lower. And my second takeaway from my own portfolio is that the dividend payout is just absolutely absurd. I'm almost at $1 million in dividends per year, and I live in New York. So can you just imagine the amount of taxes that I am paying? I'm single-handedly funding like 3 to 4 high schools to have all of their textbooks for the school year. So you better thank me for my service, young man. My third takeaway is it's pretty shocking to say the least. I mean, from top to bottom, I know what you're thinking. It's pretty darn risky. My holdings, given my age and my retirement outlook, how I'm trying to retire this year or next, because usually my peers at age 60 or 65, most people have a concentrated allocation towards VU, the S&P 500 ETF, or even VTI, the total US stock market, Walmart, Procter & Gamble, names like that, something that is safe and boring. But for me, not good enough. Now in the next segment of the video, let's go ahead and go through the 4 criteria metrics to break down the portfolio and give it a corresponding grade. The first one is going to be the asset and strategy fit. Do the positions and holdings make sense for my goal? Remember, I'm trying to accumulate stable, minimal NAV erosion income ETFs so that it can replace my active income. Overall, I would give it a C. Because when you think about it, every single one of my current positions are income first, and then it's capital preservation second. Meaning the high dividends come with a declining share price. Because if you take a look at my cost basis per share, almost every single one of them, except I think QQQI, I'm in the red, but the dividends make up for it, so my total return, I'm still in the green. So when you think about my goal, it makes sense. I don't care about my portfolio's valuation too much. I just want the dividends to be reliable and coming in every month like clockwork. And in terms of the risk, going from 0 all the way to 10, 10 being absolutely risky, for my own portfolio, I would go ahead and label it as an 8 out of 10 because I think the stock market history of every single one of my holdings, very short. It's not like we're working with 50, 60, or even 70 years of data. Best case scenario, we're working with maybe 1 or 2 years of stock market data. However, it is worth calling out that the strategy of doing covered calls and options to collect distributions on your puts and calls, that strategy, that's been around for a really long time. And hedge funds have been executing and profiting off of that for a really long time. But for the ordinary person like you and I, a retail investor, to be able to buy into something that's doing that strategy, it's short history. So as it stands right now, this money machine, this portfolio that's generating $965,000 in dividends, it's pretty darn risky in comparison to, say, VTI or VU. If that's like a risk level of a 1, My holdings, an 8, I think it's pretty justifiable. And in terms of the quality of holdings, usually I like to look for, do they have an economic moat or not? Are they compounders? Are the fundamentals sound? But in this case, it's a little different because we're talking about and evaluating income ETFs that do options, calls, puts, and synthetic positions and whatnot. So it's a little different. But based on their short history and their dividend profile, I'll go ahead and say that I do like QQQI, the NASDAQ 100 income ETF. I do like the YieldMax Alti, and this is pushing it, but I kind of like the Maggie because it includes the big tech names like Microsoft, Amazon, and Google. And when I think about it in the long run, big tech and the Mag 7, they should thrive. Sometimes they might have a pullback and a correction where they go down, but in the grand scheme of 10, 20, 30 years, they should be okay. For my other holdings, I'll be honest with you, I'm ambivalent towards the Robinhood one. I think right now they're going through a short momentum going up to the sky, but who is to say that it won't come crashing down? So that one, I'm 50-50. Now, with that said, my other holdings, after taking a closer look, I'm like, dude, what was I thinking? Because I do not like my AMD and the NVIDIA ETFs. Now, NVIDIA as a company is solid as a buy and hold, but to generate distributions from their performance thriving in the stock market, NVIDIA has ups and downs. It tends to be pretty cyclical and volatile because they operate in the semiconductor space. And especially with the geopolitical barriers that seems to happen almost every single quarter between two of the biggest countries' economic powerhouses, it makes me hesitate because in retirement, to have my distributions, my dividends generated from options done from some of the more volatile, growth-oriented stocks, fundamentally, objectively, that is a little scary, right? So overall, I do have some of the more better quality income ETFs, but some really shaky, volatile ones where their NAV erosion is pretty hard to turn a blind eye towards. So I would argue overall a C minus, just slightly below average. Not bad, but certainly not good as well. And when we think about the dividend sustainability, the reliability, is it going to keep growing? Is it going to shrink? I think the dividend reliability here is going to be a mixed bag. I think what causes concern is when I think about these really high income ETFs, when they debut on the stock market, I think their dividends are fantastic and juicy for like the first week or even for the first quarter, meaning 12 weeks or 3 months. But I think as time goes on, their share price almost always seems to get demolished and gets obliterated. And when the share price gets crushed, the dividends have to come down as well. Case in point, if I pull up AMD's income ETF from YieldMax and we just look at their total stock market history, they debuted at about $20 and they're currently $7.63. We could do the exact same thing with the NVIDIA one. They debuted at about $20. They reached a high of about $30, and now they're currently $16.33. And that's because the underlying NVIDIA has been crushing it. If we take a look at their past 1 year, it almost copies their exact same stock price pattern. But if we take a look at YieldMax, the congregate holding of all the various YieldMax ETFs, debuted at $20. Now they're $12.65. I think you get the point. With most of these high income ETFs, it comes at a cost. And that's why I personally think that YieldMax should simmer down their ambitious dividend yields. So I think they aim for at least 80% for most of their income ETFs. But if they were to just bring that 80% down to like 25 or 30%, I don't think the shareholders would complain, because then the NAV would be more sustainable and the dividends wouldn't decrease as drastically. Because if I pull up the AMD income ETF from YieldMax and we take a look at their distribution, in the beginning, they used to pay out $1.11, and sometimes it was like $1.41, $1.67. But see how the dividend payouts get smaller and smaller and smaller? It's in line with their share price getting crushed. If I show you what's happening right here, when they used to pay out like the $1.40 or whatever, the share price was like roughly $15, maybe even like $20. But as the share price gets smaller and smaller, so do the dividends. And that's because they're trying to maintain this crazy yield. And to be honest with you, NAV erosion is not the worst thing in the world as long as the dividends keep up. But in the case of YieldMax ETFs, because the NAV erosion is so freaking drastic, I don't like how the dividends are getting smaller and smaller for each share that you own. And then, of course, something else that this portfolio is missing is dividend growth. With these income ETFs, as you just saw, out of the gate, they pay a lot. But as time goes on, that dividend payment gets smaller and smaller, which means right now my portfolio might generate $965,000 in dividends, but as time goes on, it'll shrink down to $800,000, $700,000, $600,000 if I don't drip. But if I drip and I buy more shares, then that'll boost the dividend income because I have more shares in my portfolio. So ideally in retirement, I think I'm learning right now that with a passive income portfolio, not only do you want the reliable income, but you also want to see that dividend payout be growing so that my passive income can keep up with the rate of inflation. Fluctuates between like 2 to 4%. That's a general rule of nipple. 3%, because the value of $1 today will not be the same 5 to 10 years from now. I need a bigger dividend payout so that $1 can have the same purchasing power. And that's what my portfolio is missing. So overall, the dividend sustainability, I'm going to go on record and say that it is risky. Number one, the dividend's getting cut, the dividend's not keeping up with the rate of inflation, plus NAV erosion, plus the lack of dividend growth. So now that I had time to take a look at myself in the mirror after taking a cold shower with my ding-dong all shriveled up, I think I'm realizing that maybe my portfolio, it's a little risky. So if I were to make modifications, because I'm crazy and I like talking to myself, in terms of the 7 holdings, look, I really hate to do an extreme makeover and get rid of everything and do drastic plastic surgery. But here are the modifications that I would make with my portfolio. Number 1, I would have SCHD. Number 2, I would keep ALTI. Number 3, I would keep the NASDAQ 100 Income ETF from NEOS. And then number 4, I would include GPIX, the Goldman Sachs variety of the S&P 500, their income ETF. Now, initially, I thought about adding REITs and BDCs. However, those ordinary dividends would get crushed by New York taxes. And so I tried to formulate a portfolio where a bulk of the distributions are categorized as return of capital, otherwise known as ROC, which is preferable for me because I live in the state of New York where my tax burden is ranked number 50 out of all 50 states. Now, if you're wondering why ROC distributions have better tax treatment, then go and watch the video that I made on that topic. I'm going to go ahead and assume that you understand why that is. And because of ROC, that's why I have ALTI represented, plus the QQQI and the Goldman Sachs S&P 500 Income ETF. And then with SCHD, they're a part of the mix because we need that dividend growth. That way, our payout grows year over year, and their dividend payment is not going to be taxed at the ordinary tax bracket, but rather they pay a qualified dividend, which means it's going to be taxed at the capital gains rate, 0, 15, or 20%. In my case, it's going to be taxed at 20%. So playing with the exact same amount of money that I have allocated in my portfolio of $2.1 million, this is how I would break it down. Now, obviously, SCHD would have the biggest piece of the pie at 28.7% of the portfolio, but hey, at 3.8% dividend yield, believe it or not, that's not too small of a yield. I think that's quite juicy. And what makes it even better is the column to the right of them. Their dividend growth rate is 10.3%. That's absolutely bananas. So even though you might scoff and dismiss their dividend payout of $23,781 for year 1, that's going to keep growing year over year. Whereas with ALTI, QQQI, and the Goldman Sachs S&P 500 Income ETF, it's only going to grow at a very sluggish pace. Barely 0.5%, barely 0.7% year over year. And if you're wondering why ALTI is such a big piece of the pie, it's because instead of drastically reducing or cutting the shares, I decided to keep it as is, as it stands right now in the portfolio. Personally, I would want this to be a smaller allocation, but it's better to just leave it alone. And besides, if you take a look at their dividend payout, it's $478,000. That is absolutely funny money. But anyways, the average dividend yield, taking into account all of my holdings, would be 28%. Now, it's not going to be 80%, it's not going to be 90%, but 28% is still in that pretty wild category. And the weighted dividend growth rate, taking into account their dividend growth rate plus their allocation to the portfolio, it would be a 0.5%. So no, it's not going to keep up with the rate of inflation, but demonstration purposes, year one, the dividend payout for this modified portfolio should be $612,000. And in year two, it should jump up to $615,000. And if you're wondering why did I pick these four, it's to cover all of my bases. You have two of the biggest indexes represented, the S&P 500 and NASDAQ 100, but you also have an ultra-high dividend distribution player in Alti, plus one of the best pound-for-pound dividend growth ETFs in SCHD. Because, dude, I'm almost 64, right? My birthday's coming up, and a little birdie told me that wealth preservation should be my priority instead of accumulating wealth or going YOLO into riskier income ETFs. However, even just saying that, I do want to throw out this rebuttal because Alti, it's the only one out of this mix where I do feel a little iffy about because their NAV erosion is pretty significant. But since April, I would argue it's pretty stabilized. So despite the significant NAV erosion, their total return is favorable. I know it's crazy to hear because I think they debuted on the stock market at $20 a share and it's just been slowly going down. And you might be like, then how the heck would you make money if it keeps going down? Well, I actually made several videos examining and taking a look at the numbers and math behind how Alti brings you out ahead. It's pretty crazy. You should watch those videos if you haven't already. But going back to my current portfolio as it stands right now, jump on over to the dividends tab, $965,000 a year in dividends. The dividend yield is 44.9%. Let me just say this. Whenever the dividend yield gets above 15% for almost any investment asset class, that's when things start to get a little wild and a little scary. That tends to be true for BDCs, REITs, and these option strategy income ETFs like what you see on your screen right now. For REITs, let me go back and say this. I think anything above 7 or 8%, and it starts to get a little hairy. I think the sweet spot for REITs is usually around 6 to 7%. For a BDC, usually about 10 to 11%. But whenever something goes near that 15%, that's when you got to pause and reevaluate the situation like, dude, is this actually a good dividend paying machine? Or am I going to be losing money by buying into them? And having said that, when I think about the newest income ETFs that seem to be debuting almost every single week from like Roundhill, Neos, YieldMax, look, when they run out of the gate, it's hot, right? $20 a share, $50 a share, and sometimes they even go up in valuation. However, time and time again, what I have seen is a pattern and a trend. After their initial high, they start declining and dropping week after week. It happened with Tesla. The Tesla income ETF started out at $40. Now it's $9. See, when they first started out, they even jumped up to about $43.50. And then it just decreases, declines, and drops as the weeks go by. And it's not just Tesla. Even this one right here, one of the newest ones. Let's see. Yes, SLTY. Let's see, they debuted at about $50 and they've just been dropping week after week. And it's not just this one, we got QDate as well. They debuted at $45 and it's slowly been dropping week after week. And unfortunately, I think that's also going to happen to Weekly Pay, ticker symbol WPay. They just debuted, but see how they had their initial high of people piling their money into it, and now it's slowly going on that inevitable sell-off where their share price is going to get smaller and smaller by the week. Obviously, right now, there's only 2 weeks of stock market history, but based on the trend and the patterns of everyone else that operates as an income ETF, probably most likely their fate as well. And that's why I'm coming to the realization that when it comes to these income ETFs, I don't think I want to buy them when they're at their ambitious price, especially near their IPO. Because as we see with Alti, they debuted at $20 and they've also just been declining week after week. Except I would argue since April, they were $5.45 and now they're $5.43. pretty much stabilized. But all I'm trying to say is, why buy into these high income ETFs? I'm not talking about SCHD or DGRO or DIVO, some of the more stabilized income ETFs with a modest dividend yield, but I'm talking about these ones that pay a dividend yield of like 50, 60, 80%. Why would I want to buy them when they're at $20 or $50 right out of the gate, when eventually they're going to turn into $5, $6, $7, or even $8 a share? And that's why, even though I hesitate with saying that Alt should be a part of the modified portfolio mix, I think they did find their sweet spot of around like $5.45. It seems to be stabilized at around that price point. Obviously, if they drop down to like $4 or $3, I think the show is over, because they're just going to keep falling and falling until they get delisted. But if they stay around $5.20, $5.40, even like $5.80 past 1 month, around those price points that I just mentioned, now I could be wrong. They could jump back to $6, $7, or $8, but seems like this is their sweet spot. So I know the modified portfolio looks a lot different from the current portfolio of 7 holdings, dropping it down to 4, including SCHD. That's really, really conservative, but I mean, it just looks and feels more sustainable, especially in regards to the share price appreciation, but also the distributions. SCHD, they're not going to cut their dividend. Yeah, their share price might be a little flat right now, but at least it's not eroding. Likewise, with QQQI and the Goldman Sachs income ETFs, I think they're going to be stable. Actually, I'm going to correct myself. I think with the QQQI, I think their share price will appreciate at a very tiny rate. Likewise, same thing with the Goldman Sachs S&P 500 income ETF. I also think they'll experience the very smallest share price appreciation. But with Alti, it looks and feels different from the bunch, right? And that's why, in a perfect world, instead of Alti having about 22 to 25% of the portfolio allocation, I would do a 33% split among the big 3, as in SCHD, GPIX, and QQQI, which means in that perfect world, Alti would not be a part of that conversation. But if that were to happen, I think that would be a huge significant blow, because Alti is currently responsible for about $478,000 in dividends. So to drop them and to lose that amount, it would be pretty drastic. But as it stands right now, with a 0.51% dividend growth rate generating $600,000, dude, it's not bad. Actually, this is still significant, and this is a bigger dividend payout than probably 99.9% of dividend investors out here. However, as we understand by now, Miguel, he doesn't like to play it safe and conservative. I think Miguel does not mind being too risky. So if high yield is the name of the mission, then I guess 90% into the big 3, and then the remaining 10% can go towards these volatile speculative income ETFs from Roundhill or YieldMax. I think then it's a happy middle ground, but to be honest with you, allocating this much towards Alti, it makes me feel a little uncomfortable, right? 25%. I think I understand why most investors like Alti over the other YieldMax ones, because Alti does have a better track record and performance. So I think it really depends. I think it depends on risk tolerance. Me personally, I cannot stand risk. I would rather go for the safe and steady 4 or 5% than going gung-ho into 80% knowing I could lose all of my money. So everything that you just heard out of my stinky, dirty mouth that has a lot of phlegm right now, I'm biased. My risk tolerance is probably on the lowest setting. And something else to keep in mind is, by doing this high income strategy, it does come at a price, because you're going to be inevitably sacrificing share price appreciation in favor of that passive income right now. Whenever you have a very high dividend yield, there's no such thing as a free lunch. You do got to make sacrifices, and the sacrifices come in the share price appreciation, meaning your portfolio's valuation of about 2.1 million, it's not really going to grow. As a matter of fact, because of the high allocation towards Alti, it might even shrink, unless you're dripping, of course. And I say all of that because doing this strategy right here, this might work for Miguel and makes sense for Miguel, especially in what he wants and his risk profile. But for someone that's like in the middle of their working years and trying to accumulate as much wealth as possible, like you're 35, like I am, or 45 or 55, this probably does not make sense. Now, please do keep in mind that none of this was financial advice, and none of this will ever be financial advice. This was just me being sick as I am right now, just having some fun, roasting, reviewing, and pretending to be Miguel. And at the end of the day, I'm a genuine idiot. So please keep what I said in mind. I'm stupid. I don't know what I'm talking about. Now, before I sign out of here, I do need to give some recognition. I wanted to praise somebody for contributing towards the baby diaper fund. Shout out to Justin. Thank you so much. Now, funny enough, as a Procter & Gamble investor, I was all set for Pampers, right? To buy boxes upon boxes of baby diapers. But my wife is pretty adamant about trying cloth diapering. And at first, as I was watching the YouTube tutorial videos of reusing cloth that your baby just pooped and urinated in, pretty disgusting. But I think based on my math and the cost savings of reusing those cloth diapers, I think my wife might be onto something. And on another note, if you guys don't mind, I'm going to be taking a rest day tomorrow. I usually don't rest, I work every single day, but between you and me, dude, working while sick with the flu-like symptoms that I have right now, it's like running a marathon in high heels. It sucks. I feel absolutely terrible right now. I apologize for the low energy. I really had to rely heavily on my script today. Like, my brain is so slow. I'm not able to think quickly, so I do apologize. But anyways, if you made it to the end of the video, thank you. I love you. Stay safe. Good luck in the stock market, and hopefully I can just lay down and get some rest and feel better. That way I can produce better quality content for you guys in the future. Anyways, see you guys.